You know that feeling when you're watching a stock just take off only to see it suddenly crater? Well, what if you could actually spot the warning signs before the fall? Today, we're going to learn how to read the market's own signals for a potential downturn. Let's get right into it.
I mean, it's the million-dollar question for every single trader, right? The price is climbing, everything's looking good, but you're always wondering, for how long? How do you spot that exact moment when the tide is about to turn?
Well, what if I told you there's a way to see the storm clouds gathering on the financial horizon? They're called bearish candlestick patterns, and you can think of them as the market's own weather forecast, signaling that the sunny uptrend might just be coming to an end.
All right, to get you fluent in this new language, we've broken it all down into 5 clear steps. We'll start with the basics of what these signs are, then look at simple and complex patterns, cover the super important step of confirmation, and finally, see how to turn all this knowledge into a real-world strategy.
So let's jump right into Section 1, reading the market's warning signs. I mean, before we can understand the story the chart is telling us, we need to know what the words, the signals, even are.
So what exactly is a bearish candlestick pattern? Think of it as a visual alarm bell that goes off on a price chart. These specific shapes are the market's way of signaling that an asset's upward momentum is running out of gas, giving you a crucial heads-up that a downtrend might be just around the corner.
Okay, let's move on to Section 2 and start with the easiest signals to spot. These are the single candles. Think of them as the very first hint that the weather might be about to change.
Now, these patterns have some pretty dramatic names, right? And for good reason. Each one tells a story of rejection. The shooting star? That shows buyers tried to push the price way up, but sellers just slammed it right back down. The hanging man tells a similar story of struggle at the top of an uptrend. And the gravestone doji? That one's a really stark warning that buyers showed up for a minute, but completely lost all control by the end of the day.
So here's the crucial takeaway. Spotting one of these patterns after a strong uptrend is a major warning sign. It's the market telling you, hey, the buyers are getting tired and the sellers are starting to test the waters.
All right, let's move on to Section 3, the more complex stories told by multi-candle patterns. If a single candle is just the first sign of bad weather, these patterns are when the storm clouds truly start to gather, painting a much more convincing picture.
This first group of patterns, they all tell a story of overwhelming selling pressure. Take the bearish engulfing pattern, for example. That's when a big red candle completely swallows the previous green one. Talk about a dramatic shift in power. And the 3 black crows, that's a series of 3 long red candles just marching downwards, signaling a very strong start to a potential downtrend.
And you know, the stories can get even more nuanced. Some patterns signal pure exhaustion, like the evening star. It's a 3-candle pattern that can mark the absolute peak before a reversal. Or you've got the bearish harami, where a small red candle is totally contained inside the previous green one, suggesting that upward momentum has just hit a brick wall. And then there are others, like the falling 3 methods, which are actually continuation patterns. They signal a brief pause that just confirms the downtrend is still in full swing.
Okay, this brings us to one of the most important parts of this entire explainer. I'm serious. Section 4, the confirmation checkpoint. Because, you know, seeing a pattern is one thing, but knowing if you can actually trust it, that's a whole other ballgame.
I really want you to focus on this quote. Bearish candlestick patterns work best when confirmed to reduce false signals. This right here is the key that separates the amateurs from the pros. A pattern is just the hint, okay? It's not a guarantee. You have to look for more evidence to back it up.
So how do we do that? It's a pretty simple 3-step process. First, you spot a potential bearish pattern. Second, and this is key, you don't act yet. You confirm it using other tools and indicators. And only then, third, do you evaluate the risk and decide if it's a real opportunity.
So what are these confirmation tools? Well, first up is trading volume. A bearish pattern is so much more convincing if it happens on a huge spike in selling volume. Second, moving averages. If the price breaks below a key average, like the 50-day, it adds some serious weight to that bearish signal. And third, you've got indicators like the RSI, which tells you if an asset is overbought and might be due for a pullback. These tools help you build a much stronger case.
Which brings us to our final section, from charts to strategy. Okay, we've learned the alphabet, we've learned the grammar. Now let's talk about why this skill actually matters to you.
So why learn all this stuff? It's because it has direct, real-world applications. It helps you know when to sell and lock in your profits before a big downturn. It can help you spot opportunities to bet against the market. And, maybe most importantly, it's just a powerful tool for managing risk and protecting your money when things get chaotic. At the end of the day, price charts aren't just random lines. They're a record of human psychology, of fear and of greed. They are literally telling a story about the constant battle between buyers and sellers. And after today, you have the tools to start reading that story for yourself. So the only question left is, are you ready?